All right, today we're tackling a really interesting one. Chicago Atlantic BDC, ticker symbol LIEN. And it really is a puzzle. You see, on one hand, you've got these numbers that just scream by me. They look almost too good to be true. But on the other hand, there's some pretty serious red flags waving. So let's dive in and try to figure out what is really going on with this company.
So let's just start with a number that gets everyone's attention, 14%. Yep, that is the approximate dividend yield Chicago Atlantic is paying out. I mean, in a world where we're fighting for every single percentage point, a number that high, well, it definitely makes you sit up and take notice.
But then you see this number. The company's stock is trading at a staggering 25% discount to its net asset value, or NAV. Now, NAV is basically the audited on-paper worth of everything the company owns. So what this means is the market is letting you buy $1's worth of their assets for just 75 cents.
And that right there is the big question, isn't it? Are we looking at some kind of incredible, overlooked opportunity here? Or is this a classic value trap, just waiting to spring on investors who get a little too greedy? To get to the bottom of that, we have got to understand what this company actually does.
Okay, so let's peel back the layers on Chicago Atlantic's business model, because the entire story behind these wild numbers is rooted in one of the most dynamic and, frankly, one of the most challenging industries in the U.S. today.
So, first off, what even is LIN? Well, it's a business development company, or a BDC. If you're not familiar with that term, don't worry. Just think of it like a publicly traded fund that acts as a bank for small and medium-sized private companies. You know, the kinds of businesses that are often too small or maybe too specialized to get a loan from one of the big traditional banks.
And Chicago Atlantic has picked a very specific niche. See, because cannabis is still illegal at the federal level, all the big banks, they won't touch the industry. And that's exactly where LIEN steps in. It's become a specialized lender, providing absolutely crucial capital to these state-legal cannabis businesses that are, for all practical purposes, locked out of the entire traditional financial system.
Now, you might be thinking that sounds incredibly risky, and you're not wrong. But here's how they manage that risk. LIEN doesn't just hand out blank checks. They focus almost exclusively on something called senior secured loans. Now, those two words are critical. Senior means if a borrower gets into trouble, LIEN is first in line to get paid back. And secured means the loan is backed by a real asset, like property or equipment. So for such a high-return sector, it's actually a surprisingly conservative way to operate.
So you've got this unique business model that basically splits investors right down the middle. On one side, you have the bulls, who see a deeply undervalued company with massive potential for returns. And on the other side, you have the bears, who see a completely unsustainable dividend payment that's only possible because the company is taking on huge risks. Let's break down both sides of this argument, and we'll start with the bulls.
All right, let's look at the optimistic case for Chicago Atlantic. And the argument is built on some really compelling data points that suggest there might be some serious value here that the broader market is just missing. The whole bull case really starts and ends with that massive dividend. That 14% yield isn't just a number they pulled out of thin air. It's directly funded by the high-interest loans they're making. Think about it. Because their borrowers have almost nowhere else to go, LIN can charge very attractive rates on its loans, and that income flows directly through to shareholders.
And the opportunity to make more of these loans looks absolutely massive. Right now, LIEN has an investment pipeline of $732 million. Now, to put that into perspective for you, that is more than double the size of their entire current loan portfolio. It signals a huge potential for growth, assuming they can actually put that capital to work.
Okay, so they're lending at high rates, but are people actually paying them back? Well, this number is pretty telling. 0. As of their latest report, the company had exactly 0 loans on what's called non-accrual status. That's just the industry term for a loan that's really late, like 90 days or more overdue. So this means every single one of their borrowers was paying on time. That is a remarkable sign of portfolio health for any lender, let alone one playing in the cannabis space.
And the good news for the bulls doesn't stop there. First, you've got that massive 25% discount to asset value we already talked about. Second, there's a huge potential catalyst on the horizon, federal cannabis rescheduling. If that happens, it could boost the cash flow of LIEN's borrowers by something like 20 to 40%, making these loans even safer. And finally, it looks like even the professional skeptics are starting to have second thoughts. Bets against the stock fell by over 15% just last month.
But okay, that's the sunny side of the street. Now we have to look at the other side of the coin.
Because for every single one of those bullish arguments, there's a serious risk that explains exactly why that 25% discount exists in the first place.
And the entire bear case really just boils down to this one critical question. A 14% yield is fantastic, no doubt about it. But for how long? Is it actually sustainable, or is this thing a ticking time bomb?
And this, well, this is the number that keeps the bears up at night. 170%. That's Chicago Atlantic's dividend payout ratio. Let me break that down. It means that for every dollar of net income the company earns, it's paying out $1.70 in dividends. And on the surface, that just looks completely, totally unsustainable.
But hold on, it's not quite that simple. The story here is a bit more nuanced. This is where we have to understand the difference between technical accounting income and the actual cash the business is generating. While the company's official net income doesn't cover that dividend, there's a much more relevant metric for BDCs called net investment income. And recently, that number came in at 36 cents a share, which did cover the 34-cent dividend for that quarter. So while the long-term accounting looks terrifying, the recent cash flow has been enough to get the job done. The whole debate really hinges on whether or not they can keep that up.
And it's not just about the dividend. There are other real concerns here. For one, the company's fate is completely tied to a single, very volatile industry. That's a huge concentration risk. In fact, when the whole cannabis sector got weak earlier this year, that's exactly when the stock's discount to its asset value got even wider. And of course, like any lender, they're exposed to bigger economic risks that could hurt their borrowers' ability to pay their loans back.
So you've got the bulls, you've got the bears, two really compelling but totally opposite cases. So what's going to determine who's right? Well, here are the key things that you need to be watching that will likely decide where LIEN goes from here.
This table is basically your roadmap. First up, keep an eye on the earnings call on May 14th. That's going to give us the latest numbers on asset value, loan quality, and most importantly, whether their income is still covering that dividend. Second, watch how fast they turn that massive $732 million pipeline into actual income-generating loans. Third, any news at all on federal cannabis rescheduling is a major wildcard that could change everything overnight. And finally, just keep watching that NAV discount. If the market starts to believe the bull case, that gap should start to shrink.
Which brings us right back to where we started. Chicago Atlantic is a classic investment dilemma. You have this undeniable risk of lending to a volatile, federally illegal industry. The question is that risk worth the incredible 14% reward, plus all the potential upside from that massive discount? The answer is probably going to reveal itself in the data over the next few quarters.